Hello, Marc from ADM ISI, with some thoughts this week on the moves in rates and how it's impacting credit. Let's start with the US Treasury Move Volatility Index. I think the key thing here is as much as the rise in yields appears to have capped itself somewhat as we reach that 175 mark on the US 10-year, which is considerably higher, obviously, than the current S&P dividend yield. But it's remaining, relatively speaking, elevated, clearly not nearly as high as the sort of levels we were seeing at this time last year, but still not as calm as it had been. And that's certainly a marker in the sand, effectively, that markets are taking some assurance from the Fed's forward guidance, but still questioning it. Nevertheless, if we move on to my second chart, there are other issues there which do not just relate to the Fed's forward guidance. This is the US dollar FRA OIS spread for the end of the year. And as one can see, particularly over the last 10 days, it has spiked quite sharply wider. We're not at levels, obviously, again, where we would infer from that a good deal of money market problems. But clearly, the decision to end the exemption of the supplementary treasury leverage ratio for US treasuries for the major banks has forced some reconsideration. One can also look at this in a slightly different way. If you look at the September-December 2021 versus March 22 Eurodollar spread contracts, you'll see that they're all widening out. Whether the big banks basically are trying to pressure the Fed into reconsidering or at least reintroducing some sort of supplementary leverage ratio tweaks later on is up for some debate, but it does create some volatility at the short end of the curve, which had been hitherto actually quite absent. So how is this playing out in the credit space? Well, I think this is where the interesting things are. My third chart today is the US investment grade versus the US high yield average OAS spread, chart which I use very familiarly. First of all, a little warning on this. It's slightly deceptive in the sense that it's two scales, and the white line at the top is actually investment grade, and the blue line in the lower part is actually high yield. What I'm trying basically to emphasize here is that the Treasury volatility has actually prompted some widening in investment grade spreads, and yet high yield spreads are pretty much close to their lows. So we've actually seen high yield spreads effectively tightening versus investment grade spreads, which would seem to imply that some people seem to think that high yield is some sort of safe haven, which I'm not really sure is a very good idea. Clearly, there is a precedent. If we look back at the period between 2002 and 2003, when the Fed also had a very firm forward commitment in terms of rate guidance, we had this same sort of phenomenon happening there, where people were chasing yield in the high yield sector. I think the only difference this time, the primary difference this time is obviously there seems to be a greater commitment. Secondly, I would remind everybody that back in 2004, after that period, we had a very sharp underperformance of high yield. And five, I think on this one, the other big concern is that a lot of the issuance that we're getting in the high yield sector, which is being gobbled up, is actually in the high yield energy sector. So we've got that sort of high yield outperformance. My fourth chart is just to demonstrate that there is appetite across the board. It's the Asia Barclays USD denominated high yield spread. And as one can see, that's actually been tightening in. It's pretty much close to the lows that we've seen over the past year. So there's people gobbling that up. That said, obviously, there is a much bigger risk premium in the Asian sector. Finally, my last chart is this little curio about US call option volumes, which have been staggeringly high. But since we started getting more Treasury volatility, we do seem to be coming off quite sharply in overall volumes. And that perhaps sends a warning sign that risk appetite is certainly in the equity market is not what it was. Those are the thoughts for this week.